Good afternoon, Gochi. Nice to see you again.
Good afternoon, Mr. Charles. So we'll be starting in 3 minutes time to just make room for people to join us.
FYI, we are also live.
Okay, it's 3 minutes now, so I believe we can go right into it. Good afternoon, everyone. Thank you for joining us this afternoon. It's my pleasure to welcome you to the second edition of the Vetiva ETF Town Hall Unitholder webinar. I recall the first edition we had, I was so glued to my screen because we had a lot of insightful speakers. So I'm very sure that this edition promises to be even better. This session is for our unit holders. We've come to talk to you to let you know how ETFs has done this year, and most importantly, to hear from you, to get feedback from you on how we can serve you better, how to be better, and how we can all grow together. During the course of this session, we have some ground rules. All microphones must be turned off, and if you have questions, you can drop them in the Q&A box. When it's time to speak, you can use the raise hand function, and all your questions will be answered. And then one last thing to mention before we move forward, we have some goodies, some special freebies for all our unit holders as a way of saying thank you. So I urge everyone to be attentive and as interactive as possible so that we don't miss out on these goodies. So without further ado, I would be handing over to our managing director to take us to give us her opening remark. Over to you, Oyi.
Thank you so much, Ugochi. But before I start, Adedayo Adefenwa has a question. He's asking if the recorded session will be shared, and if yes, where it will be viewed. So I think if you could provide information as to the session being recorded and where it can be viewed, then I'll give my opening remarks. Thank you.
Okay, thank you so much, Pri. Thank you so much for the question. Yes, the session is being recorded, and after the course of the meeting, we are going to share it to your emails. Thank you so much.
Okay,
back to you.
it's also live on YouTube, I believe.
Yes, it is.
Okay. Thank you so much, Ugochi. So I would say good afternoon, esteemed unit holders. Good afternoon, our partners, United Union Trustees, UTL Trustees Limited, and everyone on this call. On behalf of the entire Vetiva team, it is my absolute pleasure to welcome you to our second ETF unit holder town hall webinar. You know, this is not just a gathering. It is more than just a meeting. Rather, it is a reflection of our unwavering commitment to continuous engagement with you, our valued investors. Your trust and partnership inspire us to create platforms like this, where we can share insights, we can address your questions, and also keep you informed about developments in the ETF space. Before we dive into today's discussions, let us take a moment to remember and reflect on our first webinar. In our inaugural session, we introduced the fundamentals of ETFs. We explored their roles in portfolio diversification and also shared performance highlights across our offerings. We addressed your questions on liquidity, cost efficiency, and other consideration. I believe the feedback from that session was invaluable, and it reinforced the importance of transparency and accessibility. And that webinar shaped the agenda for today's town hall meeting. This continuity is deliberate. We want every engagement to build on the last one. That way we ensure that you're always equipped with timely and relevant information. So as we stand at the threshold of a new year, we recognize that planning and positioning are top priorities for every investor. The financial markets remain dynamic. They're shaped by evolving trends, regulatory changes, global economic shifts. And in this environment, ETFs continue to play a pivotal role, offering diversification, liquidity, and cost efficiencies for portfolios of all sizes. So today's town hall meeting has a clear purpose. One is to apprise you of ongoing trends and performance updates across our ETF offerings, to share our strategic outlook for 2026, so as to help you align your investment decisions with emerging opportunities. Also to provide clarity on how these instruments can support your long-term goals. In addition, we'll be exploring key market themes and updates across the market, examining economic factors that could influence your portfolio strategy. Our objective is simple. We want to ensure that you have the right information to make informed choices and to reaffirm our promise of transparency and accessibility. So before we proceed, I would like to emphasize that this session is designed to be interactive. We encourage you to ask questions, to share your feedback, and engage actively, because your insight helps us to serve you better and also strengthen our community that we are building together. So thank you once again for joining us. Together, we'll continue to build a strong, resilient investment ecosystem, one that thrives on knowledge, trust, and collaboration. I would like to wish you also a Merry Christmas in advance, compliments of the season. Thank you. Ugochi, over to you.
Thank you so much, Oye, for that warm welcome. I'm sure we're going to have a very engaging and inciting session. So without wasting so much of our time, we'll be going to the next item on the agenda, which is going to be a very brief presentation from our research team and our fund managers. So taking us on this, I'll be calling Abigail Alabi, our head of research, to take us through this session. So I'm going to be sharing my screen shortly. Over to you, Abigail.
Good afternoon, Ugochi, and good afternoon to everyone on the call, and welcome to the second edition of the Vetiva ETF unit holder town hall meeting. And as Ugochi said, I'll be taking us through the overview of the macros that happened in 2025, and also the equities market, as well as our outlook for 2026. Next slide, please. Okay, So for this year, we saw that or just starting strong. We saw strong GDP growth in 2025, and this was driven by a number of factors. First was the rebasing effect that took place in January of this year. So last year we saw that the NBS announced that there was going to be a rebasing of the GDP methodology and also the inflation methodology as well. And that was a huge turning point. I saw that the base year for the calculation of those metrics were changed. And that was a key contribution to what we saw in GDP growth in 2025. However, we still saw that GDP growth was between the range of 3.4 to 3.6. We saw that for Q3, it printed at 3.98% for Q3 2025. And we saw that this was largely driven by the services sector, which has continued to dominate economic activity. We also saw that the trade, telecoms, and also financial services sector remained primary growth drivers that we saw in Q3 2025. For the agricultural sector, even though we saw a bit of contraction in the previous quarters or last year, we saw a bit of slowdown in last year, we started to see signs of stabilization, and this was driven by recovery in the fishery subsector and also continued dominance of the crop production subsector. However, we saw that a key takeaway from 2025, or a key story that was a clear turning point for the macroeconomic environment in 2025 was inflation rates. So we saw that inflation peaked above 30% last year. And like as I mentioned earlier, we saw a rebasing that caused the methodology to change. We also saw a better reflection of the current consumption patterns in Nigeria, and that also informed the critical change that we saw in the base year and also the numbers that we saw in 2025. So after a prolonged period of upward trajectory of inflationary numbers, we saw that for this year, inflationary pressures began to ease, and for the month of October, we saw that inflation closed at around 16.05%. And so far, it has maintained, or we've seen a disinflation trend for the 7th consecutive month so far in 2025. And this is not just a mechanical, or this is not just because of the rebasing effect as well. We also saw that food inflation also declined throughout for most of the year. Even though it was a bit sticky at the very beginning of the year, we started to see food inflation decline, even reaching a deflation where we saw a negative number for food inflation, and this was driven by improved food supply as well as the commencement of harvest season, which also drove food supply. For core inflation as well, we also saw that also declined significantly, and a key factor that drove the overall inflationary decline that we saw was also stable PMS prices. So far we have seen a stable or a somewhat measured decline in global crude oil prices, and that also affected what we saw in the Nigerian market, and that also affected the decline in PMS prices. And for energy, or for inflationary subsectors that are energy influenced, we also saw that those also declined as well, reflecting the significant growth that we have seen on the back of the PMS decline. And also for FX reforms, that was also a crucial factor for disinflation as well. We have seen that 2024 was laying the groundwork for the FX reforms that we have seen. And so far, this current CBN regime has been able to accurately improve the confidence that we have seen in the FX market. So we've seen structural reforms. We have seen significant effort by the CBN to clear a lot of this backlog, and that has improved the confidence from not just domestic investors, but also from institutional investors as well. And those are like the key overview that has happened. So overall, we've seen stable macroeconomic trends in 2025, and that will just set the pace for what we expect to see in 2026. Next slide, please. So moving to the equities market, and at the end I'll give a roundup of what we expect to see for both the macro and also for the equities market. So far this year we have seen that the equities market has done significantly well. First is the corporate earnings that drove the trading sentiment in 2025. So for the first quarter of the year, for the first few months of the year, we saw the full year results being released for various sectors. And because of the impressive results that we saw, that drove bullish sentiment that we saw in the equities market. However, as the year went on, we saw that this performance was we saw that its performance was continuing across all the sectors, especially for the consumer goods sector, as they were coming from a much more difficult 2024, and we saw a reversal of those losses that they made in 2024 up until 2025, and those were the key drivers to what we saw at the performance of the equities market. And also for the improved macro trends, like as I mentioned earlier, we saw that improved macro trends, policy consistency, and also FX stability was able to restore confidence in the Nigerian market. And these are all key metrics that foreign portfolio investors have been tracking to ensure that Nigerian equity market is a good destination for foreign inflows. And because of this improved macro trends, we have also seen that foreign participation has also significantly increased compared to what we saw last year. However, we still saw that domestic participation was still a dominant factor that drove transactions in the equities market. As we have seen in the graph on the slide, we have also seen that domestic participation has significantly increased, and this is also on the back of corporate releases that also support investor sentiment. We also saw dividend payment as well from companies who were unable to pay dividend due to recorded losses, and that also spurred the trading sentiment or the bullish sentiment from local investors. And also since the beginning of the year, we've also started to see that inflation has been declining. And as a result, we saw that the CBN also started to gradually ease the MPR rate. And as a result, we saw that FPR or fixed income yields started to trend lower. And that also translated into increased activity. We saw an influx of investors moving from the fixed income market also take position in key fundamentally strong stocks in the equities market. So all of these factors were key drivers that also drove what we expected in. These are the factors that drove what we saw in the equity market in 2025. And as you can see, the consumer sector was a key performer, followed by the banking, insurance sector, and also the industrial and the banking sector, due to the number of factors I also mentioned now. Next slide, please. Next slide. Okay, so what do we expect for 2026, and what are the big forces that we expect to shape 2026? First is the policy reforms and the risks that we are anticipating for 2025. First is growth momentum. As I mentioned earlier, we have seen a strong economic growth, and this was evidenced by the numbers that we saw, the 3.98% growth we saw for GDP in Q3. So what do we expect going into 2026? Do we expect policy reforms to still continue and also still drive growth that we are seeing in the services industry, agricultural industry, and also the industrial goods industry? How will this policy reform still continue and also influence what we see in 2026? Also, for FX reforms as well, like I mentioned earlier, we saw that the CBN has laid the groundwork in 2024, and we began to see a lot of these results from this groundwork in 2025. So what do we expect going into 2026? Do we expect these FX reforms to still continue, or do we expect the CBN to intensify its effort to stabilize the FX market? And also structural reforms as well. Do we expect domestic refining to also increase and also reduce import dependence? We also mentioned earlier this year, or sometime last month or middle of this year, there was an import tariff levied on importation of KMS prices, which has been suspended. If that should also be reintroduced next year, how would that affect the structural reforms going into 2026? And number two is naira stability, all aspects on FX liquidity. So do we expect, like I mentioned earlier, for the first point, do we expect the unification to still continue? Do we also expect the oil output to still fuel the FX or the oil receipts, and also give the CBN ample liquidity to also defend the naira? And do you also expect this to also sort of inform the transparency that we have seen in 2025 and do we expect that to also increase in continue in 2026? And number 3 is a trajectory of inflation and also interest rates. As I mentioned earlier, we have seen a downward trend in inflation rate, and that's also informed the decline in MPR rate that we have seen in the past 2 MPR meeting. So if inflation is also expected, should inflation decline going into next year, that means we'll most likely see a gradual easing of the MPR rate. However, should we see a reversal of the progress that we have seen in inflation, this will most likely cause the CBN to either tighten rates or to keep it as it is, or further tighten the rate in 2026. And for investment funds and capital market depth. And so what do we expect to happen next year? And this will also be linked to the first point of the outlook that we expect to see for 2026. So now that we see that 2027 is, or we are approaching a pre-election year, 2020 is a pre-election year, with the presidential election coming into focus in 2027, what do we expect capital investment inflows to look like in 2026? And I'll be coming from an FPI perspective. So FPIs typically tend to track political stability and how that will also affect policy reforms and policy consistency going forward. So for the pre-election year, we'll most likely see foreign investors stay on the sidelines and trying to adopt a wait and see approach to see how this presidential election will pan out. First, do we expect to see a new administration come in and also sort of reverse the policy reforms that we have seen? Or do we expect to see a continuation of this current administration? And that will also give a much more predictable outcome when it comes to policy for the policy consistencies. And for FX stability, we also see that FX stability remains a key determinant of market direction. And this also impacts the companies listed on the NGX as well, especially for the consumer goods sector, basically for all the sectors on the exchange. 2024 was a very difficult year because of the FX stability or FX illiquidity that we have seen. And because of the reversal that we have seen, that was the key drivers to some of their financial performance. So if you see FX stability continue in 2026, that will still be a key driver to the gains that we have seen across the equities markets, and especially for the companies that are also import oriented when it comes to their raw materials, and also basically the day-to-day operations of some of the USD or some of the import dependent companies on the exchange. And the next one is strong domestic participation. While I mentioned that the FPIs may stay on the sidelines or adopt a wait and see approach to see if we'll continue to see political stability, that may not be the case for domestic participation. Over the last few years, we have seen that domestic participation has been a key driver, has been a key dominant, or has been a dominant factor to transaction on the NGX. So we expect that this will still continue into 2026, as we expect that investors will still be on the hunt for yields, given the fact that we are seeing softer yields in the fixed income market. So earnings performance also remained a core driver. This year was also a testament to how earnings performance was a core driver to the performance that we have seen across the NGX. And should that also continue, should we see this impressive earnings also continue, that would also be a key, a crucial point to what we expect to see in the Nigerian equity market in 2026. And also for softer interest rates, inflation has maintained its downward trend, and we have also seen that also impacts the body language of the CBN, as well as their interest rates, or as well as the interest that we have seen in 2026 and going into 2025 rather, and going into 2026, we expect that should inflation still maintain its downward trend, that would also give the CBN enough room to also ease the MPI rates, and that will also influence the yields and also the rates in the fixed income markets. So overall, we have the outlook for 2026 is a very cautious one, or we have a very cautious optimism about what we expect to see for 2026. And even though we have seen significant improvement, we have seen political policy stability and also reforms that have shaped the economic conditions in 2026. We are also very cautious about what could happen in 2025 rather. We're also cautious about what would happen in 2027 and how that would also affect what we see, or how that will also affect the the global market. So do we see, or should we see any reversal in these key factors, or should we see a reversal in the macro trends that would also cause a down, or that's also a downside risk that we expect to see in 2026. So overall, we are approaching despite the improvement that we have seen in 2025, we are approaching 2026 with cautious optimism, and also keeping in mind that should all of this progress that we have made so far in 2025 get reversed in 2026, that can also sort of change the optimism that we are seeing for the next year. And this is also okay, so for the general equities market, so this year has been a very good year. And for the general equities market, we also expect that would also continue in 2025, and also breaking it down by sectors as well for the sectors that are also the key ones to watch in 2026. First is the banking sector. So for the banking sector, we have seen that this year has been a significant year for them, and we've also experienced significant growth driven by strong fundamentals and also strong economic conditions. And so what are the key things that also drive the outlook for the banking sector in 2026? First is the recapitalization exercise. The second one is interest rate dynamics. The third one is FX stability and also earnings normalization. So for the recapitalization, we saw that earlier in 2025, we saw 2024 rather, we saw that CBN came up with the directive for banks to recapitalize, and that will also enable them to also strengthen their balance sheet. So, and now that the deadline is approaching in 2026, what does that mean for the banking sector? So this means that this also means that the banking sector can also return to balance sheet strength and also strengthen its resilience in case of economic downturn. And we also see that the certain banking names are also better positioned for 2026 in terms of the fact they also have strong retained earnings. They also have strong capital buffers that can also help them to perform better in 2026. And for other banking names as well, we also expect them to also do significantly well based off of the progress that we have seen across key names for the recapitalization exercise. And also for interest rates, now that we have seen, or now that we have reached the peak for the tightening of interest rates, we expect that banks would also expect a normalization of bank earnings in 2026. So even though we expect to see interest rates will decline, and that will also affect interest income for banks, we also expect that this will still stimulate credit demand, and also this would also reduce funding stress as well, because banks now have the capital buffers to also adequately provide for bad loans, and also adequately provide for impairment charges, FX exposures to bad loans, and also forbearances as well. So this is also a huge one for them, because we also expect that this will also improve the asset quality, given the fact that we expect that rates will somewhat decline in 2026. That would also drive earnings quality. And for FX stability, we have seen that for banks, this would also help them to further manage FX liquidity and also diversify income streams. So rather than windfalls that we have seen in the past quarters, we'll most likely see the banks also tilt towards a more sustainable earnings compared to the FX driven earnings that we have seen in previous years. For the last one, which is asset quality, we also that despite the macro stress, we saw that asset quality has significantly improved in 2025, and we expect that to continue in 2026. So we expect that this will also drive the valuation and also dividends for banks in 2026. We see that many of the Nigerian banks are still trading below 1x of their book value, and we still see that dividends are still remaining very attractive relative to some of the investment or some of the investment of asset classes that we have seen. So despite this, we still see that there's a lot of upside for the banking sector. For the consumer goods sector, we also expect them to further continue to drive, or we expect impressive earnings for the consumer goods sector in 2025. First is the Naira stability, which has also helped them to further plan ahead when it comes to input cost and also FX losses as well. So for FX stability, we expect them to also see a reversal and also have FX gains in 2026. And for the industrial sector, which is also a very, very key one. So historically, whenever we have a pre-election year, we tend to see an increase in infrastructure development. We tend to increase, or this tends to also have a positive impact on cement demand and also basically construction activities. So now that we're approaching a pre-election year, most likely see this also significantly improve the earnings for the industrial goods sector. So overall, the macro trends, or these are the forecasts that we have for the macro trends. We also expect inflation to still decline. We also expect GDP forecasts to also continue to grow at a measured pace in 2026. And for the equities market, we also expect that the outlook will still remain strong, given the fact that if the macro trends to remain very, very strong. We also expect to see strong domestic participation. And given the fact that we also see inflation starting to decline, that would also impact the interest rate and also drive the influx of investment into the equities market. Thank you. And that's it for me, Tochi.
Thank you so much, Abigail. That was a very insightful presentation. I mean, we see that next year is a big year for the equities market, especially because it's a pre-election year. I can see that we have a hand up. We'll be taking questions after this session. But I would also implore everyone to drop their questions in the Q&A box. And then once it's time for the question and answer segment, to take each and every one of them. So without wasting so much of our time, I'm going to be calling on Mrs. Jason Shetutu to take us through the ETF performance for the year. Over to you, Jay.
All right, thank you very much, Ugochi, and thank you, Abigail, for that very insightful session. So now I'm just going to be walking us through how the Vetiva ETF have performed in 2025, as well as key milestones of what we've been able to, a couple of milestones we've been able to achieve this year, and also our outlook or expectations for 2026. So with respect to the ETF performance, Vetiva's ETF performance in 2025, I think just riding off on Abigail's conversations with respect to how the equities market have performed generally. From this slide, we can see that the different Vetiva ETFs we have, like the Vetiva Griffin 30 exchange traded fund, whose objective is basically just to track and replicate the price of the NGX 30. We can see that the ETF is closely tracking the NGX 30 index, which is an index that tracks the top 30 stocks on the Nigerian exchange group. Then with respect to year-to-date return, we see that it has returned about 35.64% year-to-date, which definitely is higher than, what inflation has done. I know the inflation rate currently is around 16%. For the banking ETF, Vetiva banking ETF, the objective is also to track and replicate the performance of the NGX banking index. And from the graphs, we see that it's also closely replicating the index that it's supposed to replicate. And if we also look at the return, we can see that it has also delivered 31.19% year to date. While the consumer goods ETF as well, which is the Vetiva Consumer Goods Exchange Traded Fund, has returned 103.49% year to date, which also explains the fact that it's closely tracking the index that is meant to track. And aside from that, it also buttresses the points that Abigail had, highlighted earlier on how the consumer goods sector has rebounded this year on the back of, the stable exchange rate and, other macroeconomic indices. While for the industrial goods sector as well, we can see that the Vetiva Industrial Exchange Traded Fund as well has returned 65.59% year to date. And from the graph, we also see that it's closely tracking the NGX index. So all in all, I mean, it's very clear to see that all the Vetiva equity exchange traded funds have returned over 30% year to date. So next slide, please. Now I'm just going to be walking us through what we've done this year. So this year we've paid dividend twice. We paid the 2024 final distribution in Q1. We can see it on this slide for Vetiva Griffin 30 ETF, banking, and also the S&P. We've also paid 2025 interim distribution in H2. We made that payment in October, 30th October 2025. So these are the dividends we've paid. I know one of the things we have highlighted, just as Oye said in our introductory session, was during the inaugural Townhall webinar we sort of showed a breakdown of our historical dividend payments, and we highlighted the fact that a couple of our ETFs have paid distributions yearly since they got listed. Example is the Vetiva Griffin 30 ETF, which was listed in 2040, and we've consistently paid distribution every year. So this basically just aligns with the fact that you have investors who are looking for investments that pay distribution, and the ETFs are a very good investment opportunity. Go to next slide, please. So on to our expectations for 2026. So going forward, riding on what Abigail has said, we expect that in 2026 we would see increased buying sentiment in the equity market, and that's basically due to the softer rates that we expect to see in the fixed income market. We also expect that there will be rebalancing by the NGX, and that would also be replicated by the fund managers in January and July. And rebalancing is typically done twice a year, just like we have here in January and July. So what typically happens then is the NGX Index Committee reviews the underlying constituents of the indices. And when they review the underlying constituent of the indices, they then, rebalance it in line with the objective of that index, like the VG30 ETF or the NGX 30 index rather, which is the index that tracks the top 30 index. During rebalancing, the NGX tries to ensure that when the rebalancing is done, the index is capturing the top 30 stocks as at that day, because before the new year, definitely there'll be price movements, changes in different positions. So it's the objective of the NGX Index Committee to ensure that the different indices are capturing the actual position with respect to what should be in the underlying constituent. Another expectation we see in 2026 is that we expect that there will be dividend payments for the Vetiva exchange-traded funds in alignment with the trust deed of the fund. So investors that continue to search for investments that pay dividend, the Vetiva exchange-traded funds are a good investment opportunity. We would also see more positioning in ETFs because investors will become more aware about the diversification benefits that ETFs offer, like the banking ETF, for instance, which tracks the top banking stock. For investors who are interested in just having exposure to the banking sector, they easily can take positions by just buying additional units in the banking sector. Or for investors who are even interested in, just getting easy exposure to the market, the Vetiva Griffin 30 ETF is an ETF that, is diversified across different sectors. So whether it's the consumer goods sector, the banking sector, industrial sector, just by purchasing the ETF, they get indirect exposure to those different, to the underlying constituents. Then I think the final thing that we have here is that just like what Abigail said, we would see more corporate releases in 2026, and we expect that that would drive trading sentiment in the equities markets. And when we see higher increased trading sentiments in the equities market, because the underlying securities of the equity ETFs are equities, we expect that we would also see investors purchase or trade the equity ETFs in line with that. Also noting that majority of this underlying majority of the underlying indices, majority of the underlying constituent of these ETFs, they are also companies that would declare or release results in 2026. So as they release the results or release their result, we expect to see that also trickle down in the performance of the ETFs in 2026. So I think I'll just I'll just stop here and just hand over the mic back to the moderator, Ugochi. Thank you very much.
Thank you very much, Jay. I think you and Abigail have done a very great job in enlightening us. We'll very shortly get to our panel session where we'll be answering all the questions that we'll be having. But before then, I would like to hand the mic over to our trustee, Mr. Charles Moikoje, to give his comment. Over to you, Mr. Charles.
Hello, good afternoon. Can you hear me?
Good afternoon. Yes, you're very audible.
Thank you very much, Ugochi. Thank you very much, Vetiva team. Honestly, this has been a wonderful year for us and for the Vetiva team. So on behalf of UTL, I just want to say a few words, of course, to our unit holders. So on behalf of the UTL Trust Management, I wish to reiterate our unwavering commitment to the Vetiva Exchange Traded Fund and to the protection of the collective interests of all unit holders. The role of the trustees is one we appreciate with great responsibility, and we remain fully dedicated to ensuring that each fund is administered with a high standard of governance and transparency. In the discharge of our duties, we continue to maintain a rigorous oversight structure that enables us to monitor compliance with the trust deeds, Investment and Security Act, the SEC rules, and of course, the regulation itself, as well as all other operational and reporting requirements expected of a regulated collective investment scheme. We work closely with the fund managers to ensure adherence to regulatory obligations and to promote practices that strengthen investors' confidence. Over the years, particularly 2025, our engagement has extended beyond routine oversight. We have consistently reviewed fund activities, examined investment exposure, monitor income distributions, and provided timely guidelines to ensure that the fund remains aligned with their investment objectives. As market conditions evolve, we remain attentive to emerging risks and opportunities. And we continue to act at all times in the best interest of the unit holders. Looking ahead, UTL Trust remains committed to maintaining a governance environment that supports growth, efficiency, accountability across all the Vetiva ETFs. Our intention is to continue to act with independence, professionalism, and integrity, ensuring that unit holders are protected at all times and that the funds are managed in a manner that inspires trust and stability. We appreciate the confidence placed in us as your trustees and reaffirm our dedication to safeguarding the assets and long-term interests of all unit holders. In addition to all this, I also want to say a very big thank you to Vetiva for honoring our one-day collaboration training on the CIS with SEC officials. It was a big success because you came and other fund managers also attended. So we use this medium to say a very big thank you to you. Thank you, Ugochi.
Thank you very much, Mr. Charles. Thank you so much for that warm comment. So we will now be going into our panel session where we'll be answering all your questions. And I implore everyone to be as interactive as possible because don't forget, I had mentioned earlier that we have freebies, so we need you to be interactive so that we'll be able to, make our judgments very fair and in the spirit of Christmas and all that, share with you guys. So without further ado, I'll be inviting our panelists. The first person I'll be calling up is Mr. Shenwo Shomo, the head of securities dealing and brokerage. I would also be calling up Mrs. Jesse Shetuto, a representative from the fund management team. Mr. Ola Koha, also a representative from the fund management team, and Mrs. Abigail, Miss Abigail Alabi, our head of research. Good afternoon, distinguished panelists.
Good afternoon, Ugochi, once again.
Good afternoon, Jay. Good afternoon, Ola. Good afternoon, Sheung. And good afternoon, Abigail. So I think we'll just go right into it, and we'll be taking the first attendee that has his hands up, Mr. Michael. I think you can say your question now. Over to you, sir. Okay. I think while we wait for Mr. Michael Uyilike, we have some questions in our Q&A box. The first question is, what sector would you advise to focus? What sector would you advise to focus in 2026? I think I'll direct this question to Abigail to answer.
Thank you, Ugochi. So as I mentioned, so far this year we have seen that all the sectors on the exchange did really well. And we expect this to also continue in 2026. So the banking sector is still a viable sector to also still invest in 2026. We have the industrial sector as well, which also has very strong fundamentals. And we also expect increased activity to also drive their financial performance. For the consumer goods sector as well, they've been enjoying a relatively good year. And we expect that to continue in 2026. For the insurance sector as well, we also expect a lot of activity going on next year, as they're also entering their own capitalization exercise as well, where they're also required to increase their capital and their capital adequacy or their capital requirements. So we expect a lot of activities to go on in the insurance sector. For the oil and gas, they've had a relatively difficult year due to the happens in the global landscape and also the domestic market as well. So hopefully we expect to see reversal in the oil and gas sector next year. But overall, a lot of all the sectors on the exchange are very, very good, are very crucial stocks to also watch out for in 2026. We also expect to also take position across fundamentally strong names as well.
Okay, thank you so much, Abigail. Our next question is to specify the easy channels of buying Vetiva ETFs. I think we have two questions on that topic. So I would be handing over to Jay to answer that.
Yes.
All right, thank you very much, Ugochi, for that question. So, easy channels of buying the Vetiva ETFs. So we have our Vetiva Trader portal, which we're going to drop the link shortly. You can actually use the Vetiva Trader portal to purchase the Vetiva ETFs easily. So once you just log in or sign up to the website, if you've not signed up, you can easily just, once your account is created, you log in and you buy the Vetiva ETFs seamlessly. Aside from that, I think for Vetiva ETF unit holders that most likely purchase through other houses, you can also easily, buy the Vetiva ETFs through their apps or their online portal. But one very easy way to purchase it is, just through the Vetiva online portal. And if you have issues purchasing it, you can always reach out to us at sales@vetiva.com, and we would always be there to assist or guide you through. I hope that helps. Thank you, Coach.
Okay, thank you very much, Jay. We still have more questions coming in. We have this question: what edge and buffer does an ETF provide over direct stocks in a company? Ola, I think I'll be handing this over to you today. Confirm you got the question.
Yes, they're asking about how
What
ETF
edge and buffer does an ETF provide over direct stocks in a company?
Yes. So I will start by saying that investing in one company, that the equity market, usually you have two risks when you come to the equity market. You have the systematic risk, and then you have the unsystematic risk. Systemic risks are risks that all the companies in that particular sector are exposed to. And then also unsystematic risk is the risk that the company itself has because of either its gearing, its capital structure, its management team, and all those things. There are some risks you cannot diversify away. But then if you only have stocks in one company, you're exposing yourself to both the systematic and the unsystematic risk that one company will give you, as against buying an ETF, which gives you a broader view of the market, gives you one piece of all of the stocks in that sector. So effectively, you've diversified away your unsystematic risk, and you have now fully diversified your portfolio. You reduced all the risk, and if the sector does well as a whole, you are also going to be sure that ETF will do well as a whole versus one company which could have any changes, any number of risks could crystallize for that one company, and that means that you'll be losing all your investments in that one company. So the ETFs, in the broader sense, give you a sectoral view, or a sectoral view of the market, and then you're also able to diversify your portfolio and reduce the level of risk that you're exposed to versus investing in just shares of one company.
Okay, thank you so much, Ola. Jay, do you have any additional thoughts on that question?
No, I think Ola captured it adequately well. So the ETFs help with diversification, just like Ola has said. If it's the VJ30 ETF, for instance, we have stocks in different sectors that are in that ETF. So if one sector is really performing really well, because there are still other stocks stocks in other sectors in that ETF, it helps the performance of the overall ETF at the end of the day. So I think diversification, as opposed to, just being invested in a single stock. So you're more exposed to the downside risk of holding just one particular stock. So really, ETF helps you to diversify, which helps to reduce your risk. So I think Ola really captured it well. Thank you.
Okay, thank you so much, Jay. We have questions coming in. So our next question is, do I have to buy Vetiva ETFs directly from Vetiva, receive distributions, dividends, to receive distributions or dividends rather? Does settlement for Vetiva ETFs when sold comply to the recently implemented T+2 settlement window? I'll be handing that over to Jay to take.
Okay. So you need to invest in the Vetiva ETF to definitely receive distributions, but must it necessarily be that you must compulsorily buy the Vetiva ETFs from Vetiva? No. Once you have stockbroking house you're using, you can always buy through them. But aside from that, like we said, you can always buy additional units of the Vetiva ETFs from Vetiva. Then I also believe that the T+2 settlement would apply to Vetiva ETF, because the Vetiva ETFs are exchange traded funds, and it means that they are funds that are traded on the exchange. So the T+2 would apply. I don't know if Sheung, head of dealing, has any additional comments to it to that. I think I can yield the floor to him.
Yeah, thank you very much, Jay. Like you had mentioned, settlement of ETFs just in line with the regular settlement that we have for equities in the market, right? Or for every other equity that is listed in the market. Now it's T+2. It used to be T+3, like I believe most of us are aware of. So they settle just like equities, the regular equities in the market. So I think that's just what I'll add to that.
Okay, thank you so much, Shion. So our next question is, as we are aware that the ETFs in the US are well monitored to ensure the ETF price regularly mirrors the NAV. The case has not been the same for most Nigerian ETFs as prices have been massively higher than NAV of the sector they represent. What is Vetiva doing differently to ensure your ETFs prices monitor the NAV? So I think I'll give that question to Shion.
All right, thank you, Ugochi. And I think I quite agree with that question. We've seen a couple of these ETFs being trading significantly higher than the NAV. Not entirely sure how these, because it pretty much brings some form of disjointed valuation to those ETFs. So you're entirely not able to purchase and know that you are investing in a security that directly tracks the index or a bucket of particular shares or a particular sector. But for Vetiva, what we've done over time is to make sure at every point in time, our ETF, they largely trade in line with the NAV as well as the index that they track. So over time, even now, if you check it, looking at the NAV as well as the current price in the market, you know those ETFs are trading significantly around the NAV. And then obviously you won't, there's always room for maybe a bit of differences, maybe 5, 6, 7%, in some cases because of how market trades, just like you have with other securities. But most times what we will see is that our ETFs trade largely like the NAV, as well as if you also look at the index that they mirror, you see that our index largely our ETFs trade in line with them. And what we've done over time is make sure this remains the same, because it brings about price discovery, and you know that what you are investing is also mirror the underlying shares. Thanks.
Yeah, thank you so much, Shion. Our next question, I'm going to direct it to Jay. Do we have a fund that tracks the oil and gas and telecoms sectors? Oil and gas, telecoms, and ICT sector.
All right, thank you very much, Ugochi. So we don't currently have a fund that tracks these highlighted sectors. However, if you look at the Vetiva Griffin 30 ETF that we highlighted earlier, you would note that majority of the stocks there, we would see we have stocks that are in the oil and gas sector in that ETF. We have stocks that are in the telecom sector, also part of the top 30 stocks that are embedded in that ETF. So currently we don't have a fund that tracks it, but these stocks are actually in the Vetiva Griffin 30 ETF. That's stocks in the oil and gas, stocks in telecom, then the Vetiva Griffin 30 ETF. So I'll leave it at that.
Thank you so much, Jay. So our next question is, I would like to know the effects of the tax reform on mutual funds. Will they be affected or not? I'm going to call Abigail to answer this question.
Okay, so for mutual funds, so typically when unit holders sell their units, the fund simply redeems its unit at the prevailing NAV, that's net asset value, and also pays the investors in cash or directly to their account. So so this may not necessarily fall under the capital gains tax, but this is also dependent on how they also intend to implement the capital gains tax going into 2026, because now They've also gone back to the drawing board to also ensure that a lot of investments are also captured into the tax net, and also to ensure that despite the fact that they also want to implement the capital gains tax, this doesn't also cause investment apathy in the market. So now that a mutual fund is implementing investment scheme, and typically the clients are typically paid in cash, it may not fall under the capital gains tax, but that is still highly dependent on how they intend to implement this capital gains tax in 2026. Thank you,
Okay.
Jojo.
Thank you so much, Abigail. So because of time, we would be taking just one last question and would answer the other questions directly. Are the details or compositions of the ETFs made available? This is to ensure one is able to check the overall portfolio exposure in case you have individual stocks in the same sector. I will be handing over to Jay to take this question.
Thank you, Ugochi. Yes, the details of the underlying constituent of the ETFs are made available. And aside from that, we try as much as possible to share fund fact sheets with all our unit holders at least once every quarter, sometimes on a monthly basis. And what the fund fact sheet basically does is to highlight the constituents of the ETFs and also the performance of the ETF for that period. So it's usually made available. Thank you.
Okay, thank you so much, Jay. Thank you so much, Ola, Shehu, and Abigail. I think because of time, as I mentioned earlier, we're going to be attending to the other questions that we were not able to answer live. Would answer it individually. So I think this would bring our panel session to a close. And just quickly, as we had promised, we said we needed you to be interactive, and we have some freebies for you, especially people that are very interactive. So drum rolls. We have 2 winners, and we'll be giving out one of the freebies that we're going to be giving out today is an ebook, simplifying ETFs and index investing, authorized. Sorry, just a second. I would be sharing my screen for. Yes, so apologies for the delay. So we are going to be giving out 2 free ebooks, simplifying ETF and index investing, authored by our Group Chief Operating Officer, Mr. Damilola Ajayi. And Vetiva is also going to be giving a waiver for ETF purchases executed through our Vetiva Trader platform from Monday, 15 December 2025 to Wednesday, 31st December. We are going to, in due time, communicate the details of this waiver. But for our ebook winners, just a second. Our ebook winners, we have Mrs. Precious Bolarinwa and Mr. Chidiberi Ezekiel. So we are going to be reaching out to you guys, but we will need you to send an email to etf@vetiva.com to claim your prize. So thank you so much for being very interactive, and I'm very, very sure that we all enjoyed this session, and we had a lot of takeaways from everything that our panelists and our speakers has presented today. So without wasting much of our time, because this was supposed to be a 1-hour session, I'm going to yield the floor back to our managing director to give her closing remarks. So once again, over to you, Lee.
Good afternoon again, everyone. Thank you so much, Ugochi. Thank you to all the panelists. Thank you, Sheung, Abigail, Jesu Shetutu, Olaoshe Bikon, and a very big thank you to Union Trustees Limited. Sorry, I keep saying Union Trustees Limited. I beg your pardon. UTL Trustees Limited, Mr. Charles. And, more than anything, we are very, very grateful to all the unit holders who participated in this webinar. Thank you for your time and your patience. Thank you for being open. Thank you for the questions and the feedback we've received. We're glad that we've been able to have the second town hall meeting of unit holders, and we're promising that this is just the second one, and we'll continue to engage with you to understand your needs and to be able to meet your needs. We're very optimistic about 2026, just as Abigail had given her roundup in terms of the macroeconomic outlook and also the equities market outlook. So we're optimistic that we would see positive gains in 2026, and we will continue to engage with the community, our investors across our ETFs on a continual basis. Please feel free to reach out to any member of our team at funds@vetiva.com should you require any clarification. An email would go out with the link to the recording of this session. Also, don't forget the freebie from Monday, 15th December 2025 till the end of the year. We're having our Christmas bonanza. So no brokerage on ETF purchases within this period. And we're using this to say thank you for trusting in Vetiva. Thank you for trusting in our products. And we want to assure you that we'll continue to scope the market to see areas of deepening and products and opportunities that will enable you express your investment objectives easily, efficiently, and transparently. I can see Mr. Charles' hand is up. I don't know if you want to say anything in addition to this in closing.
Yes, just to not to say anything different, but just to say we want to wish everyone a happy Christmas and a happy New Year, and hoping that 2026 will be a very exciting year for both the Vetiva Group and UTL trustees.
Thank you so much, Mr. Charles, and thank you, everyone. Wishing us all a very Merry Christmas and a very prosperous 2026 ahead. Thank you.
Thank you, everyone. Thank you. And
Thank you. Thank you, Ugochi. Thank you, everyone.
Thank you.
Have a good afternoon.
Thank you. Thank you very much.